All right, hi everyone. Welcome to today's live analysis session brought to you by IC Markets. All right, hi morning Ren, good to see you again. Right, yeah, for sure we'll cover the pound and Aussie as well. Right, and we'll of course be looking at the dollar index, a few of the other major currency pairs, the commodities and the indices as well. Right, so before we start going, let's take a quick look at the disclaimer, right? Take note that this is marketing communication and does not contain and should not be construed as containing investment advice or an investment recommendation or an offer of or solicitation for the transactions in financial instruments. Also, take note of the risk warning that comes with trading Forex and CFDs as they carry a high level of risk to your capital and you should only trade with money you can afford to lose. Right. My name is Ketan Ramachandra. So this webinar series is brought to you in a special partnership between IC Markets and Everest Fortune Group, where we have been the finalists for Best FX and Equity Research for the following years, 2019, 2020, and 2021. Right, before we dive into the charts and trading view, we've actually got a very heavy calendar this week, right? We've got three central bank interest rate decisions, and we've also got jobs data out of the US as well. Right. So with regards to the central bank decisions, we've got the BOJ up first on 31st of July, where they'll release their statement as well as the press conference, and Governor Kazuo Ueda will deliver his press conference as well. Then later on that day, same date, 31st of July, the Fed will release his statement, followed by Chairman Jerome Powell's press conference. And finally, on the 1st of August, Thursday, we've got the Bank of England as well that will be releasing its monetary policy statement, and Governor Andrew Bailey will be delivering his press conference as well. And among all of these, we've also got US employment data. And we've got ADP, the ADP employment report, which will be released on Wednesday, 31st of July. And of course, the highly anticipated non-farm payrolls will be reported on 2nd of August, which is included in the employment BLS employment report, along with the unemployment rate. Right. So here's the calendar for this week. Right. It's quite a heavy calendar as well. We've also got today's actually pretty empty. There's nothing really important on the calendar for today. However, Tuesday is when things start kicking off, right? We've got uh, home home price index, the home price index as well. S&P Case-Shiller home price index will be released tomorrow, along with consumer confidence survey by the Conference Board, as well as the JOLTS job openings as well. And on Wednesday, we've got inflation data out of Australia. We've got PMI figures out of China, and of course, we have the Bank of Japan that's due to release its monetary policy statement. Now, the Bank of Japan likes to keep markets guessing as to when it will exactly release its statement, but usually it happens at around 4 a.m. GMT time. So take note, the Bank of Japan will likely release its monetary policy statement at around 4 a.m. GMT time, followed by the press conference, which is usually conducted about 2 hours after. Now, the key policy rate for Japan currently stands at about 0.1%, right? So we may see a potential rate hike uh, at this week's uh, central bank announcement as well, right? So we can see that the recent intervention measures have worked pretty well uh, for the dollar yen. Right, intervention measures have caused the value of the yen to strengthen quite significantly, causing currency pairs like the dollar yen and all the other yen crosses to pull back quite sharply. Now, they may potentially raise rates at this current meeting. However, the press conference by Governor Kazuo Ueda will be very important as well, because if he comes out with a pretty dovish outlook, right, despite a potential rate hike, we could see the yen come under pressure once more, and that means we may see dollar yen push higher as well. Right, and then after that, we've got ADP that will release its employment report on Wednesday as well at 12:15 p.m. GMT, followed by the Fed statement that's out at 6 p.m. GMT, followed by Chairman Jerome Powell press conference at 6:30 p.m. GMT. Now for the Fed, we've seen recent inflation data start to cool, right? We saw CPI data and the PCE price index come in softer over the last couple of months. However, that's not enough for the Fed to move ahead with its first rate cut. So at this week's meeting, markets are still pricing in uh, an unchanged rate for the Fed. They're going to keep the Fed funds rate at 5.5% once again. Remember, the target range is between 5.25 and 5% now. So this is where the Fed funds currently stand. and it is expected that the Fed is going to stay put at this week's meeting. However, Chairman Jerome Powell may communicate a pretty dovish outlook, and he may give a much more clearer signal that the first rate cut will likely take place in September, at the September FOMC meeting. So that's going to take place on the 18th of September. So if we do see a pretty dovish press conference by him, we are likely to see the US dollar come under significant selling pressures, right? Despite the Fed keeping rates on hold, a dovish press conference should be more than sufficient to see the US dollar come under some overhead pressures. And finally, we have the final bank, central bank on uh, on the schedule is the Bank of England, but however, this central bank is expected to cut its policy rate or its official bank rate by 25 basis points. So they're going to bring it down from 5.25% to 5%. And along with Governor Andrew Bailey's press conference, this could be a pretty strong bearish catalyst for the cable, right? Because markets are already pricing in a potential rate cut, and if Governor Bailey turns out to be pretty dovish as well, this could add further downward pressure on cable come Thursday, 1st August. So the statement is going to be released at 11 a.m. GMT, followed by the press conference half an hour later. And finally, of course, we've got the highly anticipated non-farm payrolls and the unemployment rate and average hourly earnings that will be released on Friday, 2nd of August, 12:30 p.m. GMT. Now, we'll cover a bit of this a little bit in detail as we go along the slides. Now, just a quick recap of the previous ADP report. So back in June, right, so take note all this data that's coming up for this week. ADP here and non-farm payrolls will be for the month of July. Now, taking a quick look at June's data, we saw 150,000 jobs being added in the private sector as reported by the ADP employment report. However, job creation slowed for the third straight month, and it was also very concentrated. This was not a broad-based figure, and with job gains concentrated only in leisure and the hospitality sectors, right? Apart from these two sectors, right, if these two sectors were not included, June would have been a downbeat month, meaning there would have been jobs lost in the month of June as reported by the ADP report versus a gain of 150,000. So we can see that job growth is slowing down, right? We can see although jobs are still increasing, but the pace of job creation has slowed down. And not only has it slowed down, it is also now come in underneath this 12-month average of 162,000 for the last 2 months. Right, so this for July's figure, we have an estimate of 166,000, which is slightly above or pretty much in line with the 12-month average. So we may see a potential pickup as well. But generally, we're starting to see a slowdown in the pace of hiring as reported by the ADP report. And this signifies that the labor market in the US is starting to get pretty saturated. Now, moving on to last month's BLS employment report. So this report gives us gives us the insights into the unemployment rate as well as the non-farm payrolls. We can see unemployment rate was at about 3.8% back in March of this year, but it has risen for the next 3 consecutive months, coming as high as 4.1%. So rising interest rate like this is also showing some signs of concern for the US labor market, right? We can see here throughout 2022 to 2023, unemployment rate was approximately ranging between 3.4% and about 3.7%, right? Pretty stable. But we can see a quite notable uptick in the unemployment rate, and should this figure continue to rise higher in the coming months, it's going to pose some serious questions for the US labor market. Now, similar to the ADP report, we are seeing job growth or job creation slow down as well over the last 3 months, right? We see April's figure was revised significantly lower. April's figure was originally came in at 165,000, when it actually came in at around here 165,000. But now it's been at the previous meeting, or the previous release, it was revised lower to 108,000. So a significant decrease in job creation here. Even for May's figure, it was originally came in at 272,000, which is probably around here, but this figure was also revised lower down to 218,000 as well, right? So you can see that there were two big downward revisions for the months of April and May, and at the same time we can see June's figure coming in at 206,000, which is lower than the 12-month average as well. So we can see the BLS employment report also highlighting the slowdown in the pace of job creation as well, right? And for this week's data, the forecast for July is at about 177,000 for non-farm payrolls, and the unemployment rate is expected to remain unchanged at 4.1%. So 177,000 is about here, and it's also, you can see it's going to be lower than the previous month's figure, right? Previous month's figure came in at 206,000, and at the same time it's going to be lower than the 12-month average of 222,000. So we are starting to see some notable slowdown in the US labor market, which could cause the Fed to really move ahead with the first rate cut in September. But even before the Fed moves ahead with that rate cut in September, we are likely to see markets front run that. So that means we could see the US dollar really come under pressure this week, especially if ADP and the BLS employment reports signal another slowdown in the US labor market. All right, so this is what we have to look out for this week in terms of macroeconomic data news. Now let's dive into the charts and trading view, and we'll begin the analysis, of course, on the dollar index. All right, so here we are on the chart. Here we are on the chart for the dollar index. I'm on the daily time frame. Right, so we can see here since 28th of June, right, the dollar index hit a high of about 104.10. It stalled around this level here, and since the beginning of July, it has reversed quite sharply, stabilizing at around 103.70 last Wednesday and Thursday before retracing higher as well. Now, for most parts of last week, from 22nd of July till the 26th, we can see the dollar index really didn't do anything much, right? There's no clear downtrend and there's no clear uptrend, right? It was just consolidating between 104.20 and about 104.50, right? A pretty narrow range, right? So we could potentially see the dollar index pull back, right? So that's where the pivot has been identified. The pivot at 103.65 or the 3.69, sorry, is a pullback support level that took place last Wednesday and Thursday, right? So we could potentially see the dollar index pull back towards this level here, especially if we see a combination of slower or weaker than expected job creation as reported by the ADP and BLS employment reports, as well as the press conference by Jerome Powell should he communicate a very dovish outlook with regards to future monetary policy action. That's all of these things all will combine together and potentially function as a strong bearish catalyst for the dollar index. So take note, although the dollar index is stabilizing or consolidating around 104.40 for now, maybe for the next couple of days it's likely to consolidate within these levels. But come jobs reports day and the FOMC, we are likely to see this index pull back towards the pivot here. Now, this pivot here also has the presence of a 127% Fibonacci extension underneath it. This extension was found by running a retracement from here, 4th of June, up to this pullback resistance here on 26th of June, right? So we can see that this pullback support level here also has the presence of this extension level at 137%, adding further significance to this support zone here. Looking a little bit below, we have a combination of a swing low support that took place here in mid-March and an overlap level that's been in place since early Jan to that's been in place since most parts of Jan, helping us to highlight or identify the first major support. This first major support also has the presence of a Fibonacci extension at 161% as well. So you can see here this is nice decent overlap support level here, then a nice swing low plus the 161%, all lining up well to identify the first major support for the dollar index, which is at 102.72. Right, and for resistance, right, there's a pretty decent overlap resistance at 105.15. We can see the dollar index making a small pullback here on 19th of June before bouncing higher. And then as it broke underneath this level, it retraced a little bit higher but failed at around 105.15 before reversing to resume the downtrend. So this creates an overlap level here that we can use to identify as resistance. And at the same time, we have also run a Fibonacci retracement starting from this high on the 26th of June, going down to the low here on the 17th of July. We can see there's a 61.8% retracement that aligns very well with this overlap resistance here. So that's how the first resistance has been identified. Right, so for now, dollar index has once again uh, looks set to continue this consolidation since last week. Right, it's been roughly ranging between 104, about 104.10 and about 104.50, about a 40 pip range, and this is quite likely to continue for the next day or so until we get the jobs data as well as the FOMC meeting out of the way. Then we'll really see higher volatility for currency markets in the second half of this week, right? But for now, these are the key levels for the dollar index. So yeah, please take note of that. First resistance at 105.15, pivot at 103.69, and the first support at 102.72. All right, now let's take a look at cable as well, since we've got the Bank of England coming up on Thursday, 1st of August. And after that, we'll take a look at dollar yen as well, with the Bank of Japan also releasing its monetary policy statement on Wednesday. Right, so start off with the cable first. Once again, I'm on the daily time frame here, and we can currently see that cable is testing its pivot level here. Right, so this pivot at 1.2817, previously this level here previously functioned as like a pullback resistance, or you can even argue it's like a swing high resistance here that took place in the beginning of June. Then it had functioned as resistance again on 8th of July before finally breaking higher. So what was previously pullback resistance level could now potentially function as support, which is what seems to be happening at the present moment. Right, so we can see that cable has sort of stabilized at around the pivot for now, and this level here also has the presence of a 50% Fibonacci retracement. So this retracement was found by starting from here, this low on the 27th of June, and going up, of course, to this high here on the 17th of July, and we can see that 50% retracement aligns pretty well with the pivot here. And we can also see that cable continues to trade above the bullish Ichimoku cloud itself. The cloud is still indicating a bullish momentum. However, we can see that, of course, it's been retracing. It has been retreating away from this high of 1.3044 since last Wednesday, or since 2 Wednesdays ago. Right, so if we do see, but we have the FOMC meeting coming up first, and we also have ADP employment report before the Bank of England. So we may have a scenario where we could see the US dollar sell off first, and that means we are likely to see cable stabilize around the pivot and bounce higher as well. So remember, a weaker jobs report out of the US and a dovish FOMC outcome, right, is likely to cause the dollar to sell off, and that means cable here is likely to stabilize and perhaps potentially bounce higher. Now, then come Thursday, we may see that move reverse, especially if we see Governor Andrew Bailey communicate very dovish rhetoric on that day, combined with the rate cut as well. So, right, we can also expect this currency pair to experience wild swings from Wednesday onwards. Right, okay, so first resistance is pretty clear. First resistance is this pullback level here that occurred on 17th of July at 1.3008. And for first support also is very clear. We see a nice swing low taking place here at the end of June, right? We see a very nice swing low taking place here at the end of June at 1.2615. And not only that, we also have the presence of, I believe this is a 61.8% Fibonacci retracement. Just let me confirm. Yep, we have the 61.8% Fibonacci retracement. Let me see if I can adjust the labeling to make it a little bit more clearer, a little bit more visible. No, it doesn't really make a difference. Okay, but basically this swing low support at 1.2615 also has the presence of a 61.8% Fibonacci retracement underneath this level here. Right, so just a quick recap on cable. right? We may see this currency pair bounce in the first half of the week. Remember, we have ADP, or we have Joel's job openings on Tuesday, which is the US jobs data point. Then we also have the ADP employment report on Wednesday, 31st of July, followed by the FOMC meeting. So we could have a potential scenario where the US dollar comes under pressure first, and that means we could see cable stabilize and bounce off the pivot here. And then come Thursday, when the Bank of England finally releases its monetary policy statement, and we see Governor Andrew Bailey deliver his press conference, we could see that potential bounce, perhaps reverse and pull back once again. So whatever the outcome, we can definitely expect much higher volatility for this currency pair in the second half of this week. All right, now let's take a look at dollar yen. Right, so you can see here, since the intervention measures have taken place in mid-July, dollar yen has reversed very sharply of 162 and has dropped as low as 151.94 last Thursday. Right, so what are intervention measures? Right, an intervention measure is when the central bank takes action in the open currency market. So in the case of Japan, right, we can see the yen has weakened quite significantly, right? When you see the dollar yen go from about 104 to as high as 162 very recently, this means the value of the yen is becoming very weak, and that means Japan's although Japan's imports are more much more cheaper for the rest of the world, and it also helps inbound tourism. Japan's exports become more attractive and more cheaper to the rest of the world, and inbound tourism into Japan is cheaper for tourists. However, the flip side is the imports for Japan become more expensive because as the value of the yen loses, as the strength of the value of the yen becomes more weak, naturally the spending power of the Japanese consumer becomes weaker as well. So that is why the Bank of Japan has intervened in the open market. It was something that they did similar in where was this? In November, not November, sorry. It was the first time the Bank of Japan intervened in the open markets, right? In recent years was in October of 2022. Back then, dollar yen hit a high of 152 and it reversed very sharply, falling as low as 127 before stabilizing and then resuming the uptrend. So this is the period here in January 2023 when the intervention measures finally came to a conclusion, and that's when natural market forces returned and we could see the dollar yen move higher once more. And then there was another round of intervention measures that took place this year. First, it happened in the first week of May, where we saw dollar yen hit as high as 160 before reversing very sharply, of course, dropping as low as 151.94 as well. And then this is the second time this year where the intervention measures have taken place, and this time we've seen also a very strong reversal for this currency pair as well. Right, so if we do, the only problem, not only problem, but the only concern here is that we've got the Bank of Japan coming up with its monetary policy statement. So if they do raise its key policy rate, that could potentially function as another bearish catalyst for dollar yen. Remember, if they raise if Bank of Japan raises its key policy rate, the Japanese yen could strengthen, and that means dollar yen could reverse and drop lower. However, the press conference by Governor Kazuo Ueda is going to be equally important as well. And if he continues to bang a very dovish drum, then that means we could potentially see dollar yen stabilize and perhaps stage a minor rebound as well. So take note, it's going to be a very volatile period for all the yen crosses on Wednesday, 31st of July. Right, as of now, I see a very strong multi-swing low support here. There's a swing low support here that took place on the 3rd of May, and there's some consolidation here, like a small pullback taking place last Friday as well. So this is a nice support level at 152.91 that has been identified as the pivot. Right, a little bit below, I see a pretty decent intermediate resistance level as well at about 150.88. And where I do see a very strong support level is this multi-swing low here, or this pullback level here at 146.42 that has taken place first on February of 2024, then in mid-March as well. And we also have the presence of a 78.6% retracement lying underneath it here. So this retracement was found starting from here, 28th of December, the swing low on 28th of December of last year, going up to this year's high on the 3rd of July. So we can also see that 38.2% retracement aligned pretty well with the pivot here, and the 76% retracement sits underneath the first support. Right, so at the same time, we can also see dollar yen is trading within a very nice bearish channel, right? However, we do see a strong support area here. And at the same time, when we look at the stochastic oscillator and the RSI is here with a reading of about 29 as of today, about a reading of 29, and stochastic oscillator has dropped as low as 15, right? Both of which are indicating oversold conditions as well. The last time we saw these two indicators drop as low as this was probably here back in mid-March, and maybe we can argue here as well in early May as well. So we can see both times here we saw dollar yen stabilize on mid-March at around 146.50 before moving higher. Similarly, back in early May as well, we saw dollar yen stabilizing at around 153 before finally moving higher once more. Now, could we see something like that play out? Yep, potentially we do see the right technical signals here, RSI indicating oversold conditions along with the stochastic oscillator. So we may see a potential halt in the decline for dollar yen here, and we may see it stage a minor rebound. So take note, technically wise, on the daily time frame, we do see oversold conditions based on the RSI and the stochastic oscillator based on these two momentum indicators, right? Something similar to what we saw in the first week of March and in the first week of May as well. So just something to take note of these two momentum indicators as well. Right, okay, so in terms of resistance, there's a pretty decent overlap level here at 157.89. This overlap level here also has the presence of a 61.8 retracement. We started this retracement from here, 3rd of July, down to this low of last Thursday. You see the 61% retracement aligned pretty well with this overlap resistance at 157.89. Now I think I can probably spot an intermediate resistance as well. Let's see if there's another intermediate resistance here, probably around the 38%. So let's keep 38 and 62%. I would just like to highlight this level here as a potential intermediate resistance level as well, which is at 156.06 here. I see a pretty decent pullback taking place here on 17th and 18th of July, and it also has the presence of a 38.2% retracement. Right, so these are the key levels for the dollar yen, and also please take note, we've also got the Bank of Japan lined up on Wednesday, 31st of August, so it's definitely going to be a super high volatile period for this currency pair. All right, now let's take a look at gold. We'll switch over to commodities, take a look at gold and crude oil. Then we'll cover the indices. And of course, should you have any requests for any other instruments, please do let me know. Please do drop your request in the chat box, and I'll be more than happy to go through the analysis with you. All right, now let's take a look at gold. So here, once again, I'm on a daily time frame here. So the ticker symbol for spot gold is XAU USD. Right, so basically since approximately since mid-April till mid-July, gold was sort of trading sideways, right? It was ranging between $2,286 per ounce and about $2,440 per ounce here, right? After a strong bullish run up since mid-February till mid-April, price was basically consolidating within this box here. We can see very nice sideways trading action here, which finally got taken out briefly in mid-July, right? Gold made a new all-time high. It made a new intraday all-time high at $2,483 per ounce, right? That took place on 17th of July, but this breakout here was short-lived. We can see this breakout here was short-lived, and prices reversed to fall back into this zone once more. right? So you can see here, gold prices are not really exhibiting any clear direction, right? There's no clear bullish uptrend or bearish downtrend on a daily time frame. We do see a very strong consolidation period that's been in place since mid-April, right? Ranging between about $2,290 per ounce and approximately uh, $2,450 per ounce. Right, so if we do see the US dollar sell off this week, remember we've got FOMC, we've got employment data. If the dollar comes under pressure, that's quite likely going to function as a strong tailwind for gold prices here. So remember, the value of the US dollar and gold prices share an inverse relation or inverse correlation. So that means when the value of the dollar falls, gold prices should typically be rising, and conversely, when the value of the dollar rises, gold prices should be under pressure. So if we do see a weaker set of employment data and a dovish FOMC outcome, where we could see the dollar come under heavy selling pressure, and that's quite likely going to provide a strong tailwind for gold here, for precious metal here. So the pivot for today, for this week, on the daily time frame has been identified at $2,468 per ounce. It is a pullback resistance level that took place 2 weeks ago. That's close to the all-time high. Now, this level here also has presence of a Fibonacci extension at 127%. So these extension levels were found by running a retracement from here, 20th of May, going down to this low here on the 7th of July. We can see the 137 extension level aligned pretty close to the all-time high that took place on 17th of July. And because this is the all-time high here, we have nothing in the past to reference, right? Take note, this is the all-time high here. We have no other pullback, overlap, or swing high resistance that we can reference to help us identify the next resistance level. So in such a scenario, we can rely on Fibonacci tools such as the Fibonacci extension. And in this case, we're using the extension level at 161% to help us identify the first resistance, which is at $2,550 per ounce here. Now, in terms of support, it's quite clear. It is this pullback level here at 2,286 that has been in place since 23rd of April, and this level also has the presence of a 38.2% retracement. Right, so this retracement was found by running starting from here, this low on 14th of February, going up to the all-time high here on the 17th of July. We can see that 38.2% retracement aligned pretty well with the first support at 2,286. So take note, if we do see the US dollar sell off, right, based on weaker employment data and a dovish FOMC outcome, we're likely to see gold prices push higher and potentially rise up towards its pivot here at $2,467 per ounce. Right, so these are the key levels for gold. Now let's take a look at crude oil. Right, XTI USD is the instrument that tracks WTI crude oil futures, and we can see crude prices have been in a strong downtrend since the second week of July. Right, after hitting a high of nearly $85 per barrel at the beginning of July, prices stalled, pulled back a little bit. There was a pretty swings here, a couple of swings here that took place from in the second to third week of July before finally breaking lower as well. And we saw back then a bearish breakout take place here. We saw a bearish breakout take place on 19th of July. So this first resistance level at $80.81, this level here was previously functioning as a pullback support in the third week of June, functioned as a pullback support in mid-July as well, but that level got taken out and we saw a nice bearish breakout take place here. Right, now what was previously a pullback support level can now potentially function as resistance. So that's how the first resistance for crude oil has been identified. And this level here also has the presence of a Fibonacci retracement. It's the 50% Fibonacci retracement that was found by starting from here, 5th of July, going down to the low on the 25th of July. We can see the 50% retracement. Let me see if I can adjust the labeling to make it a bit more visible. Yeah, the 50% retracement also aligns pretty well with this pullback resistance at $80.81. Now, for this week, we can also see very clearly this commodity is trading in a bearish channel. We see a series of lower highs, series of lower lows. It's continuing to trade within a bearish channel, and we could see we have another potential bearish breakout that could take place once again. Remember, we saw a nice bearish breakout take place on 19th of July, perhaps it is level here at 77.37, where we can see another potential bearish breakout take place. So that's how the pivot has been identified. The pivot is at 77.37, which is a potential bearish breakout level here. Now, should prices continue to slide lower, right, the first major support then for XTI USD comes in at this multi-swing low level at $72.31 per barrel, right? We see a nice swing low taking place here at the beginning of February, and we see another nice swing low taking place here at the beginning of June as well. So this is a very strong multi-swing low support level that also has the presence of a 78.6% Fibonacci retracement. So this retracement started from this swing low here on 13th of December 2023, ending with the high here on 5th of April. You can see the 78.6% retracement aligns pretty well with this multi-swing low support at $72.31. So that's how the first support has been identified. So that means should we see a bearish breakout take place, right? We can identify a couple of potential take profit levels, one of which is also the 78.6% retracement here. We have the 61% retracement here, but we can use the 78.6% retracement level as the first potential take profit level for any short trades that we may have, right? This is the first take profit level here. Should we see the bearish breakout take place, right? Should we see the bearish breakout take place through the pivot, the first take profit level can be identified at $75.42. Why is that the case? Because we see a pretty decent pullback level taking place on 7th of June and the 10th of June, and this level here also has the presence of a 78.6% Fibonacci retracement. And of course, should price continue to slide even lower, we can then target this swing low support that took place on the 4th of June as the next take profit level as well, right? The next take profit level here can be identified from about $73.23. Right, so these are the way we can use the support levels to identify potential take profit levels. Should we have a bearish, should we have any short trades on? Conversely, we use resistance levels here, such as this pivot, to identify potential take profit levels for any long trades that we may have. So if the dollar continues to sell off this week, it's quite likely going to provide a steady tailwind for gold prices. So that means we can use this pivot level here, which is a pullback resistance, as a potential take profit zone. So for the long trades, for long opportunities, resistance levels such as this can be used to be identified as a potential take profit zone. And conversely, for short trades, support levels such as the ones identified at the 78.6% retracement and this multi-swing low here can be used as identification for potential take profit zones for any short trades. Right? Okay, so that's what we have for XTI USD. Let's move on over to the indices, and we'll take a look at the DAX first, and then we'll take a look at US 500. So DE40 is an instrument that tracks the DAX futures, and we can see that after making this all-time high, if you look at it on the monthly time frame here, right, the all-time high, the intraday all-time high for DAX was formed in the first week of May, and so that's on here, 16th of May here, so is the all-time high for the DAX, right? And actually, if you look at it, since the beginning of May, DAX has actually just traded sideways, right? We see very clear sideways price action, right? There's no clear bullish trend as what we saw in end of October of last year till December, right? So a period of 2 months, we saw a very strong bullish uptrend. Then we saw consolidation, right? We saw another consolidating phase here in December till February, last December to February this year, before the next strong uptrend, bullish uptrend from end of February till end of March, then a strong pullback here, and then a slight retracement to the upside. But then, as we can see, it's been consolidating once again, right? So just take note, these are the key support and resistance levels. The pivot is a pullback resistance level for the DAX, and the first support, of course, at 18,003 is a nice pullback support level here. So these range, right, these levels here can be used to identify potential take profit for long and short trades as well. So right now, right, we are likely to see DEX potentially move up, right, potentially climb over the next couple of days. So that means we can use this pivot level at 18,894 and use it to identify a potential take profit zone, right? So should we see should we see DE40 move higher, right, we can play the range, right? So basically, as uh, prices consolidate or bounces off the upper bound and the lower bounds, we can use the upper and lower bounds as entry points, right? And then we can, for example, in a long trade, we can, as price reverses of this low here on 25th of July, although it didn't hit the lower bound exactly, but if prices reverse, we have a potential opportunity to go long, and then we can target close to the upper bound, right? We can target approximately between 17,700, 18,700 and 18,900 as a potential take profit zone for any long DEX trades that we may have. Conversely, as price reverses off the pivot and or close to the pivot and starts to drop lower, we can then use this zone here between 18,100, 18,200 and about 17,900 or 80,000, sorry, as a potential take profit zone for any short trades as well. So that's why it's important to identify the trend. The trend right now is sideways. There's no clear bullish uptrend or bearish downtrend. The trend is quite clearly sideways, and we have a potential opportunity of playing the range based on these lower and upper bounds. Now, with DEX making an all-time high on 16th of May, how could we possibly identify the next resistance level? In this scenario, we've relied on a Fibonacci projection. So this projection started from here, this low on 19th of April, going up to the all-time high on 16th of May, and ending with this low here on the 14th of June. You can see that the 100% retracement level sits at, also the 100% projection level sits at 19,487. Just going to, and at the same time, we can see the 61.8% Fibonacci projection level aligned very well with the pivot, right? So the pivot also has, not only is the pivot close to the all-time high, it also has the presence of a 61.8% Fibonacci projection level, indicating a pretty strong barrier here. Now, of course, if we do see a bullish breakout take place, or if we do see a bullish breakout take place, then we can then use the projection levels at 78.6%, and the projection level 100% is potential take profit level. So that means we have a potential first take profit level at around the pivot, right? The pivot will be your first take profit level for any long trades. The second take profit level can be identified at around the 78.6% projection. And of course, the final take profit level can be identified at around the 100% projection levels, right? So this is how we can use projection levels to help us identify potential take profit zones for any long trades as well. Right, so these are the key levels for the DEX for this week. All right, now let's take a look at US 500. Right, we can see here after making the all-time high, right? The US 500 made intraday all-time high on, let me see which date was it. Okay, so it looks to be at around 5,673. So basically on the first time it occurred, it was on 15th of July. So 15th of July, it made a intraday all-time high. But since that this level, it has reversed to drop quite sharply, right? We can see it's trading within a nice bearish channel. However, we may see a potential bullish breakout take place, right? We may see a potential bullish breakout take place at the beginning of this week. And where I see a pretty decent resistance level is I see a nice overlap resistance level here at 5,571, right? We see a nice pullback taking place here on 11th of July, and then resistance taking place on the 23rd, thus creating the overlap. And this is where we can identify the pivot here. So that means should we see a bullish breakout take place, right? Remember, US 500 is trading within a bearish channel. If we see a bullish breakout take place above the upper trend line of the channel, we can then target the pivot at 5,571 as a potential take profit zone for any long trades. And at the same time, this is a pretty significant overlap resistance that also has the presence of a 61.8% Fibonacci retracement. Of course, the first resistance here is identified at 5,673, close to the all-time high. So that means if we do see price continue to climb higher, right, if it breaks through the pivot and continues to climb higher, then of course, naturally, we're going to identify the next take profit zone close to the all-time high at around 5,673. Right, on the support side, there's I see a nice pullback support taking place here at the beginning of June. Right, and this level also has the presence of 61.8% retracement. Let me see if I can adjust this to make it a bit more visible. Right, 61.8%, right? The pullback support level at 5,236 has the presence of a 61.8 retracement as well. Right, and we can also see that US 500 continues to trade above the bullish Ichimoku cloud, and last week, Thursday and Friday, it does seem to have found support just above the Ichimoku cloud. Remember, the Ichimoku cloud itself can function as a potential support zone. Now, whether it's the top of the cloud or within the cloud, right, the cloud itself can function as a potential support zone as well, which is what seems to have, which is what appears to have happened last Thursday and Friday, and we see a nice rebound in the US 500. Now, we are potentially observing a breakout, right? We may have a potential bullish breakout take place. So if this bullish breakout does occur, then we'll be targeting the pivot as a potential take profit zone. Right, as of now, we can see prices bounced off the bullish Ichimoku cloud and now is attempting to break out of this bearish channel as well. All right, so these are the key levels for the US 500 on the daily time frame. Right, okay, before we move on, I'm just going to launch a poll and truly appreciate it if you guys can give your feedback with regards to today's webinar, and then we'll continue with another one or two more analysis. Right, really appreciate it if you guys can give your feedback with regards to today's webinar. And in the meantime, let's just move on to another one or two more analysis. All right, maybe we can cover, let's see, we've covered the commodities, we've covered crude oil and gold. We've also covered DAX and US 500. We've covered dollar yen, cable, and dollar index as well, because we got three major central bank announcements lined up this week. Okay, maybe we can do one of the commodity pairs. So let's look at the Aussie. Right, the Aussie has been in a strong downtrend since 12th of July. Right, after hitting as high as 68 cents, it has reversed very sharply, dropping as low as 65.14 last Thursday as well. It does seem to be retracing higher, right? Last Friday, so stabilized around 65.30 last week, and looks to be retracing a little bit higher. However, the downside momentum still, the bias still looks to be to the downside here. Now I see in terms of resistances, there's a pretty decent pullback resistance that's taken place at around 66.35, which also has the presence of a 38.2% Fibonacci retracement. If we do see this currency pair slide lower, there's a nice pullback support level that took place here on the 1st of May, which also has the presence of a 78.6% Fibonacci retracement. And right, so this is where we could potentially see the Aussie stabilize as well. So should we see this bearish downtrend resume, this is a level at 64.69 where the Aussie could finally stabilize. Now the next major support for the Aussie is at this swing low here that took place in mid-November of 2023. And it's a strong swing low support there. Actually, maybe there's another one here. I'll probably use this as well. Yeah, something a little bit, yeah, probably here at 63.96 would be the first potential support level here. which is a nice swing low that took place on in mid-April. It's a nice swing low here as well, and then after that it would be this next swing low here in mid-November of last year. Right, so Aussie was retracing a little bit higher today, but let's see if the bearish momentum continues. We could potentially see it drop towards the 78.6% retracement, and this is where it could finally stabilize as well. All right, great. All right, thanks everyone for giving your feedback as well. Truly appreciate it. Right. Okay. So let's see what else can we do. Let's take a look at dollar franc as well. We can see here dollar franc has been in a pretty decent downtrend, right? You can see here since the 1st of May, although we see strong retracements to the upside, but generally we are seeing market structure showing us a series of lower highs and lower lows as well. So perhaps we could potentially draw a nice bearish channel as well. Yep, there's a pretty decent bearish channel for dollar franc as well, right? And although it's retracing to the upside now, it could potentially run into resistance here at this pivot level at 89.13. So 89.13 is a pivot level, which is actually a pullback resistance that took place last Wednesday, and also has the presence of a 50% Fibonacci retracement. So should this currency pair retrace higher, it could potentially stall around the pivot here and then reverse to resume the downtrend. Now, if you're playing the bounce, for example, if you're playing the bounce for dollar franc, right, that means we're going to use this pivot here as a potential take profit zone for any long opportunity. So should you have any long trades for dollar franc after making this bounce last Thursday, we can then target close to this pivot at 89.13 as a potential take profit zone for any long trades. And conversely, should that reversal take place of the pivot and dollar franc drops lower, right, we can then use this low here at 87.76 as the first take profit zone for any short trades, and of course we can use this overlap level at 87.28 as the next take profit level should dollar franc continue to slide lower, right? We see a nice overlap level here taking place that's been in place since 23rd of Jan, and we also see a 61.8% Fibonacci retracement slightly below it as well. All right, okay, so right, okay, if there are no further requests for any analysis for any of the other instruments, then we'll just take a quick recap of the economic calendar for this week and what to watch out for as well, right? Right, so we can see it's a pretty heavy calendar for this week. Got a combination of 3 central bank interest rate decisions as well as US employment data. We also have Aussie inflation, as well as inflation data out of the EU. And of course, we've got PMI reports out of China and PMI reports out of the US as well. Right, so take note, the Bank of Japan kicks things off on Wednesday, 31st of July. They're very likely to release the statement at 4 a.m. GMT. Remember, Bank of Japan does not specify the exact time at which the statement is released, as well as the press conference, right? So it's tentatively, usually it occurs at around between 3 to 4 a.m. GMT time, and the press conference takes place 2 hours later. Right, then we've also got ADP unemployment report coming up on Wednesday, 12:15 p.m. GMT, and of course, the FOMC statement at 6 p.m., followed by Chairman Jerome Powell's press conference at 6:30 p.m. Now, the Fed is widely expected to keep the Fed funds rate on hold once again at 5.5%, although we've seen inflation come in softer over the last couple of months when you look at CPI data and the PCE price index. However, that may not be enough for the Fed to move ahead with the first rate cut this week, where markets are pricing in a potential rate cut is on 18th of September. But remember, this press conference by Chairman Powell is going to be very important as well. He could potentially give the green light for the first rate cut in September, and that's probably more than enough to trigger a strong sell-off in the dollar come Wednesday. And of course, we have the Bank of England on Thursday, 1st of August, 11 a.m. GMT, where they are expected to cut their official bank rate by 25 basis points to bring it down to 5%. And of course, should we see Governor Andrew Bailey communicate a dovish outlook, that's going to add further downward pressure for the cable. And finally, we wrap things up with the non-farm payrolls on Friday, 2nd of August, 12:30 p.m. So we've June's reports for ADP and non-farm payrolls have signaled a slowdown in the pace of job creation, where we're seeing a slowdown in the pace of job creation, and the last two data points have come in lower than the 12-month average for the ADP. And also we are seeing the unemployment rate edge higher. The unemployment rate has actually increased over the last 3 consecutive months, climbing as high as 4.1%. And we've also seen a slowdown in the pace of hiring as reported by the BLS report. And we can currently see the July's forecast of 177,000 being another figure that's lower than the 12-month average of 222,000, as well as coming in lower than the previous month as well. So we are starting to see potential slowdown in the US labor market in terms of job creation, in the pace of job creation, and that is something to keep an eye out as well. All right. That's what we've got for today. That's all I've got for today, right? Thanks everyone for tuning in to today's webinar. Hope this has been a great session for you. Do look out for all upcoming webinars by IC Markets for the rest of this week. I wish you all the best in your trading journey, and I'll catch you all at the next session. All right. Thanks everyone. Take care and have a great week.